Hi, welcome to the Interaxis YouTube channel and Interaxis.io. We're going to move forward today with our risk management videos. We talked about what happens in the traditional world of insurance and hedging, which is essentially risk management. This is risk transfer, right? This is I'm taking my risk that some event might happen to lower my revenue or lower my income or lower my growth, whatever it might be, and I'm going to transfer that risk onto someone else, whether it be an insurance company or an insured pool or something. I'm going to transfer that risk because it's an event that doesn't have a very high likelihood of happening, but when it happens, it could be extremely detrimental. Okay. Then there's also hedging. Hedging is more of risk mitigation. It's some event that has a pretty good chance of happening. If it happens, it could be a pretty significant financial event, but there are abilities for me to hedge. There are abilities for me to say, if this negative event happens, I can create a positive elsewhere on my balance sheet and balance things out. So I'm going to go into a more concrete example of how this works in the traditional and potentially in the decentralized world. And I've talked about it a little bit in the hedging. So this video is going to be about hedging. I talked about it a little bit before. So, and I talked about it in terms of airlines before. So an airline might know that if fuel costs go way up, right? If fuel costs go way up, their expenses go up, which means their profit goes down, right? And then what they don't want is their profit to go down because of some event that they don't really have a lot of control over. Airline is not in the business of speculating on fuel prices or oil prices or anything else. They're in the business of putting people on airplanes and flying them around the world and making money doing it, right? So what they don't want is their expenses to go up and their profits to go down because of some event that they can't really control. So what they can do is they can go take out a hedge. They can buy options or futures on oil prices, right? So if oil prices go way up, then the airline would actually profit from the options because the value of those options. The options are created as a hedge. The value of those options has increased, and therefore the airline, their expenses might go up, but they realize some revenue also, so their profit stays even. That's the goal. That's what a hedge is essentially there for, is to make sure that the profit stays relatively even when some event like this happens. So that's what currently happens. And there are options and futures and Synthetix and everything else in the current financial world. So how is that being replicated in the decentralized world? Well, in the decentralized world, you have a few different ways that you can hedge yourself. Currently, in decentralized finance, you really have a lot of people that are just buying and selling cryptocurrencies, and now we have lending against cryptocurrencies. You have a small number of security tokens, but those aren't really significant right now. So how might it work now? Well, here's an example. Let's say I bought some ETH, okay? And I decided instead of the ETH, I actually need DAI. I need some sort of stable coin because of some contract I'm in or I want to lend it out or something. So what I've done in order to get this DAI is I've put this into the maker DAO, okay, and it has spit out DAI. So let's say I put this in here when ETH was worth $200 and I got $150 worth of DAI in here. And the protocol says at this time, again, I'm making numbers simple, that if ETH drops below $150, I'm going to get liquidated. That means the smart contract is going to take my ETH and I'm going to have to repay, and I'm basically going to lose $50 in the process. Okay, well, I don't really want that to happen. I've actually potentially used this DAI. This might already be outstanding for a loan that I've loaned it to someone else. I might have used it to pay for something, whatever it might be. I don't want this situation to happen, because if this happens, I'm negative $50. Okay, that is not something I want to happen. So what can I do? Well, I have several options actually now in the decentralized world, which is really cool because we've built these these hedging protocols and hedging tools that are really being used by the early adopters now, but what they're doing is they're being proven. So here are some of the options we can use. I can go on to Synthetix, right, who has a token called SNX. I buy my Synthetix tokens, and I'll go into a video at some point about how better to use Synthetix and why it might help, and how to go through it. But I can buy this Synthetix token. I can lock up my Synthetix token, and with that I can go on to their exchange, and I might buy an inverse ETH token with that. And what happens then is the inverse ETH is just like it says. If the value of Ether goes up, the value of this token goes down. In this case, if the value of ETH goes down, the value of synthetic, of inverse ETH goes up. So in this case, I've kind of hedged myself, that if I lose the $50 here, I might make up for it here. This might go up $50, and I'm kind of made whole. I've hedged myself, and I've probably done it in a way where it didn't cost me anything. I've just locked this in, and I might go, okay, if this goes from $200 to $300 and this starts going down, I might get out of this token here, right? Because this has actually gone down in value, right? If ETH goes up to 300, this goes down in value. But I might get out of it at some point because I go, look, I'm no longer in danger of here. I get out and I might buy this synthetic ETH at a different point. Okay, so it's not necessarily a one-to-one. So Synthetix, SNX, that's one place that I can hedge myself. Another place that I can hedge myself is DYDX. They also have inverse ETH, and in this case, it's just a trade I can make. They have an inverse ETH hedge, an inverse ETH smart contract. I can just go on to DYDX, connect my Ethereum wallet, my MetaMask, what Trezor, whatever wallet, and actually I can buy a negative ETH or an inverse ETH position. And as the value of ETH goes down, the value of my inverse ETH goes up. I can even buy, I believe it, like a 2x inverse ETH. So I can buy a double leverage where I don't have to put up as much money and I get double the movement. Okay, so DYDX is another protocol that is building these hedges in there. Another place I can go that I think is really cool is a prediction market. So Augur and Gnosis are a couple prediction markets. And this is really cool because it's a completely different way to hedge myself. Prediction markets, you might know them best as sports books. But what a prediction market is it basically relies on the wisdom of the crowd. It says, I can go make this, I can create this prediction market. I can say, what are the odds? How much do I think that ETH will go to? Do I think it will go down below 150? And I can throw out that prediction market, and in the case of Augur, I know I haven't really used Gnosis, but in the case of Augur, I throw my rep tokens in there, and I create this prediction market. And different people can come into the market and basically place wagers or place bets or put their money where they think it's going to go. So if I say, will ETH in the next 6 months dip below $150, and there might just be a simple yes or no. Okay, and if I bet on the yes, now I don't think it really will, but I might bet on the yes, because if I bet on the yes and it dips below 150, it triggers this Augur smart contract and I get paid. And I might get paid, $50 on the fact that it went below 150. So this collateralized debt position got liquidated, but I made it up here by being a part of this prediction market. Okay, so this all works in the, obviously in the world where I'm just, potentially buying Ether and making DAI and everything, and it all happens nicely within our little DeFi ecosystem, right? But how is this going to work, and how is this going to be important in the actual investing world, in the business world to come? Well, it will work roughly similar. But it'll be more either investing problems or business problems that are able to be solved through use of these decentralized mechanisms and decentralized hedges. So in the case of like DYDX and Synthetix, there might be synthetic credit or synthetic interest rate tokens that are created that says if interest rates go up, right, if interest rates go up, something might happen to the value of this synthetic token. And why might that be important? Let's say I have a large real estate portfolio. Well, I have to evaluate, okay, what are my risks if I have this real estate portfolio? Well, if interest rates go up, let's say these are single family homes. If interest rates go up, that means that the homes get more expensive for people trying to buy, because if they have to go get a mortgage or if they have to go get a loan, they're having to pay more, right? Which means the value of my homes might potentially go down. There's fewer people that can afford it. Their interest rates are going to be higher. They're going to have to pay more. So the value of my real estate portfolio might go down. So I might buy some sort of synthetic that says if interest rates do go up, that the value of whatever this synthetic interest rate token is goes up, because the value of my portfolio goes down. So I'm hedging right here. The same thing can happen with DYDX. There might be some sort of synthetic interest rate or synthetic inflation tool. In the case of Augur, there might just be a prediction market. Do I think the Federal Reserve will raise interest rates in the next year? And if that's the case, if they actually raise interest rates to a certain amount, well, I'm essentially pooling my money with a bunch of other people, and if interest rates go up or the Fed raises rates or they go up to a certain amount, that might kick off that particular prediction market, and if it goes above a certain amount, I get paid. I essentially win my bet. It could be seen as a bet, but in this case it's actually a hedge. I'm not doing it because I want to make money on the bet, because in reality I don't want my real estate to lose value. But what I also don't want is to not protect, not manage my risk. And one of my risks if I own a bunch of real estate is interest rates going up and I potentially lose value. I keep making the analogy of if I own real estate and I'm here in Houston, Texas, which is oil or energy capital of the world, and the value of a barrel of oil dips drastically, well, my real estate might lose a lot of value. So what else do I want to hedge against? I want to hedge against the value of oil. So there might be a synthetic against the price of crude oil, right? There might be a DYDX. There might be a market there against the value of crude oil. So if the value of crude oil goes way down, there might be some inverse that says, okay, I actually make money from that. Again, I can go into Augur and there can be a prediction engine. There could be a prediction market. I can create that says, will the value of oil go below $40? Because I know that's the point where if it gets below there, my real estate's going to dip in value. The city of Houston might have a tough time. However, I'm going to get paid on that token. So I'm creating, in that sense in Augur, I'm kind of creating my own hedge. Where this works, it works a lot in places where there aren't traditionally hedges available. An example I give is, again, I'm here in Houston. We have clients who are in the construction industry. And in construction in Houston, you're very tied to the weather. We get a whole lot of rain here, and a lot of times when we get rain, it lasts for days or weeks at a time. And if there's a lot of weather like that, these construction companies get very cash poor. They have a tough time because, and the reasoning is because they might start work here. So this is day one, okay, but they get rain here through here. Now here on day 30 of the month, they've only done maybe 10 days worth of work. So they only get to charge the construction company only gets to bill their companies for 10 days of work. But they had to pay employees, they had to pay for equipment and such during this whole 30 days. So they might be out some cash. On top of that, they submit their percentage for completion day 30. It might take till day 60 till they actually get paid cash for work they started doing here. Now, there really in the past hasn't been a way to insure or hedge against the weather. But you could go to, for instance, again, Augur, and create your own kind of insurance, or really technically create your own hedge, right? Because you could say, have a prediction market that says how many days of rain over 1 inch in Houston in 2019. Okay, and if that day is, if I know that if it's more than 30 days, that's going to negatively affect me from a cash flow and from an income perspective, then I might say, okay, I'm going to bet on more than 30. Right now, I hope it doesn't, because if it rains more than 30 days, I'm hurt from a business perspective. But if it rains more than 30 days, then I might win this, and maybe there are enough people involved and enough people that want or don't want that to happen, that this becomes a significant market. It's a way that we in Houston potentially can create this market and insure and insulate ourselves from things like weather that we really have no control over, and we can kind of go about our business. As I talked about in the video about insurance, now you also bring in things like oracles, right? Because who decide that it rained more than an inch for 30 days? So you have some oracle that has to come in here, like I mentioned UMA or band, that is reading different data sources, and they're the ones who might say, yes, it rained more than 30 days, trigger this smart contract, pay these people that thought it might rain more than 30 days, or put their money on, yes, it rains more than 30 days. So you have these systems, these, as we call them, money Legos, but here's where the money Legos are really helping to fit and help business or help individuals to help them with their risk management, and do it in a decentralized way, in a way that we don't need an intermediary in here. Augur is essentially just code. They're not a company. I mean, they are a company, but the Augur, the code, the protocol for the prediction engine is there. The code for Synthetix is there, and we can build upon it. The code for the DYDX protocol is there, and you can kind of build your own hedges if you need to. If I need to build potentially a weather hedge or something like that, I can potentially, within these protocols and other protocols that are being built, I can go build that myself if I see enough of a market for it. And for me, just being an individual and writing that code and not having a lot of people employed or something, I don't need to have millions and millions or billions of dollars worth of market. I can have a really small market and know exactly who they are and target them precisely, and my code can make a good bit of money for me, but it helps out all these companies because I know they need the help. And in the current centralized world, and having to wait for some sort of intermediary like an insurance company, or like an exchange, a commodities exchange, or a futures exchange or something like that, to actually create this particular financial product, and they need billions of dollars worth of potential movement in order to make the product viable, they're not going to create it. However, I know that in my city, here's what I can build this whole product that says, here's what happens that impacts these particular clients. I know what the oracle is. I know what has to trigger in order to make them have a bad day or a bad year, right? I'm going to create that prediction engine. I'm going to work with the oracle, or I'm going to create this certain hedge, and I'm going to work with the oracle, and I'm going to follow the price fluctuations, and I'm going to make it to where I can make a profit, or my code can make a profit. And these construction companies, they can be helped, and they can feel good that their profits are going to remain relatively even, that they've managed their risk. Likewise, the real estate investor, anyone like that, if you can find these small niche decentralized needs in terms of hedging, you can now build a product for it so that those people or those companies can manage their risk better. That's what's coming in the world of decentralized hedging or decentralized risk management, and that's why some of these tools that are being built like Augur and Gnosis and DYDX and Synthetix, that's why they're so important, because right now they look like they're just being used for the crypto enthusiast, and we're trading money back and forth and playing with them. But what we're doing is we're building this protocol for the future. So when there's scale and when there's a lot of use, we're stress testing it now to make sure that it's going to work. We're testing the smart contracts. We're getting them audited and everything to make sure that they're going to work when they're ready for the big stage, when they're ready for international commerce? And can we create the hedges and the insurance products that are profitable, but can help these companies in a way that we can't help them right now because we're too reliant on large intermediaries that need to increase their fees and need to make money. There's nothing wrong with the big intermediaries. They're there for a purpose, but now that we have data and now that we have blockchain and we have decentralized ledgers, we can do it a little bit better, and we can do it using code and trusting code, and we can create this risk management and these risk management tools that allow companies to potentially take away some of their risk that they can't do right now. So that's a little bit, I'll go into more details on these protocols at another time, but I want to talk about decentralized hedging and risk management. Again, so please subscribe to our YouTube channel, find us at interaxis.io, hit us on Twitter at interaxis8, and let us know if there are any other topics you want to see. See you in the next video.